All right, guys, 6 o'clock. Let's start. Let's bring ourselves up to date and go forward. So, in terms of material, you guys know Chapter 1 deals with issues of authority and some public policy issues I intertwine there. Chapter 2 deals with concept of income and its breadth. Accretions to wealth are generally taxable. We saw an independent life insurance company that imputed income is not subject to tax. We moved on, we saw chapters 3 and 4. Certain things were excluded from income. Can't cover them all, but got a taste of those things that were. Things like 102, Code Section 102, Code Section 119, dealing with meals and lodging convenience of the employer. Code Section 132, just a small taste of accretions to wealth, which for various policy reasons are not includable in income. We moved on to Chapter 6. We talked about computing gains and losses under Code Section 1001. Everyone knows the applicable tax basis code sections. 10, 10, 11, 10, 12, 10, 14, 10, 15, 10, 16. The list goes on. 10, 19. We then moved on, talking about the amount realized, and took into consideration the Crane and Tufts decision. I saw an article 2 days ago, was it? And we know that Sandra Day O'Connor made an announcement that unfortunately she's suffering from dementia, that she, like Ronald Reagan, is not going to make any public appearances any longer. But if you recall, she wrote the dissent. She was the first female Supreme Court justice. She wrote the dissent, not a dissent, concurring opinion, excuse me, in the Tufts decision. All right. We then moved on and we looked at chapters 21 and 22 about what is the character of the income. Is it capital gain? Is it ordinary income? What are the consequences in terms of limitations under Code Section 1211, 1212 for capital loss limitations? Capital gains get a tax rate preference. Code Section 1222, you have to hold the asset for more than 1 year to command long-term capital gain treatment. We talked about Code Sections 1239, 1231, 1245, 1250. These set the landscape of character issues, which obviously have tremendous importance anytime you're dealing with business property, right? Because 1231, and we're going to learn soon enough in Chapter 14 about depreciable property, all right? But when you're dealing with depreciable property, we dealt with Code Section 1231, and we saw if the gains exceeded the losses or the losses exceeded the gains. That was the main hodgepodge, but then we had a sub-hodgepodge under 1231A4C, and we had to look at Code Section 1231C of the 5-year look-back rule. So all these rules have the general rule peppered with some exceptions. Those exceptions are important. Those are the exceptions that come up in practice. All right, last class, we moved on and we dealt with the important issue of who, right? Who is subject to tax? And for example, some of you are in my income taxation of trust and estates class, right, Simone? And that's a big issue. In that class, we routinely have to confront the issue: is the estate trust taxed? Excuse me. Is the estate taxed? Is the trust taxed? Is the beneficiaries taxed? So assignment of income is somewhat a ubiquitous issue. It comes up in this class, the assignment of income, and we bifurcated Chapter 12 into 2 parts, right? I did, the authors did. First part dealt with income from services. Just see if you guys were the hit of the party. EK, were you the hit of this weekend's party? Did you name drop any cases from Chapter 12? Yes, did you name drop? Did you, I don't know what company you kept this weekend, but did you happen to name any famous Supreme Court cases this weekend to any of your friends or family? And if you did hypothetically name drop a case or two, what is the most famous case which dealing with the assignment of income? Nick, you were going to say?
I don't know.
You guys aren't going to the right parties. Jason. Okay, so don't say to the Lucas. That's like saying Hellring, right? Lucas Fierro, right? Which introduced the famous fruit in the tree metaphor, right? Lucas Fierro regarding services, essentially, whoever performs the service should be taxed on the services. Agreed? And then we got introduced to another famous case in the sphere of property, right? The second half of the chapter. Ron, do you remember the famous case? Say again? Yeah. No, it's not that famous, truth be told. David? Gotta be quick. Yeah, Leo? What's the famous case? You guys got a name drop once in a while. Prove your work. Name. Horse. Horse. Elbridge v. Horse, right? Where Supreme Court wanted to maintain the integrity of the income tax system, right? So we looked at a whole series of cases dealing, and like I said, it's one of the few times in the course that we really didn't have to look too much at the Internal Revenue Code, right? That the Supreme Court cases painted the landscape of how the assignment of income doctrine plays out. And we left off towards the end of class on chapter 14, beginning the discussion on business deductions. Now, a few housekeeping chores before we get into chapter 14. Two little housekeeping chores. One, a list of courses for this spring semester went out. So I think did everyone get that today? Spring courses. Hopefully you find something that will pique your interest. I'll do a little plug here. I am teaching the regulation of tax course. In years past, we've had a very good response. The course gets done before tax season really heats up. And I think the students who have taken it have been well served by taking the course. So consider putting that down. I'll leave it up to you. I will also be teaching international tax right after tax season. So there's an opportunity for you to, for those who have never taken international tax, their first foray into that subject. Registration does not begin until November 5th, okay? So you can't sign up yet. Also, we have about 40 people so far coming to the November 9th date. We have room for probably about another 10 or so people. If you haven't signed up, I'm encouraging you, strongly encouraging you to, because you're going to hear two very gifted speakers. And I'm not even close, these guys are really good. Professor Falk is speaking, and Professor Kornstein. Both have taught at Rutgers, and both are very gifted. And Code Section 199A can't be a hotter topic in qualifying opportunity zones. Two of the hottest topics in all of tax a week from this Friday. Couple that with dinner, couple that with a hypnotist. I can't think of a better night. EK, you'll be ready to name drop some cases, right? Okay, so if you haven't signed up, seriously consider it. I do think it would be worth your while, and should be an interesting night, to say the least. Final thing, if anyone's interested, anyone who's, if you're free, I can usually get 4 students in, and usually people are interested, and there is a Essex County CPA seminar on November 16th. That's a week from the 9th at the Hanover Inn. It's a full morning of tax issues, And if you want, we can get you in as long as you sit at the Rutgers table beforehand and say good things about the tax program. All right, so if you want to attend during the break, if you want to see me, but the first 4 people who are interested, but if you agree, if you say you're coming, please come. I just can't have an empty table, okay? So again, if you're interested in this tax seminar, it has some very interesting topics. Among them, I believe, is Code Section 199A. You just have to get there for the breakfast and, like I said, sit at a table and say good things about the tax program and try to get us some good candidates. Logistically, everyone's good? Any questions, any issues? All good? All right. So again, during the break, if you have any questions or issues, let me know. Everyone's ready to talk about business deductions. We're going to be spending quite a few classes. At least this class and next class and possibly part of or a third class on this. That's how important business deductions are. And I believe towards the end of last class, I said that when you go into Home Depot or you go into Lowe's, that you might consider as if you had 3 baskets of goods, right, when you make purchases. And I said that you might pick up light bulbs, right, for your house, for your business, or because you're engaging in a remodeling. And we said, what are the tax consequences associated with picking up those light bulbs from 60,000 feet up? What are the tax consequences associated, Ankit, with picking up those light bulbs? Do you recall what baskets?
I mean, if it's business, then it goes towards your inventory.
All right, let's go slowly. If it's business, say that again.
It possibly can go to your inventory.
Well, I'm not buying them to resell them. So it's not going into my inventory. I'm going them to spin them in. Even I can handle that. All right. So what kind of, how would you categorize that?
If it's personal, then no tax consequences.
Okay, what's your authority? What code section?
I'm not sure about that.
Tupal? How did it stand up first?
262.
262, personal expense, right? Now, if I spin it in because it's my accounting firm, and I need light, we all need light, right?
162.
162, right? Everyone agree? Business expense. And income, suppose I buy the light bulbs as part of remodeling. So again, income? If you buy it as part of a remodeling project, the light bulbs?
Are you to capitalize it?
Capitalize what code section? Perla? 263, right? Right? So we have 3 different code sections, right, guys, at play. We're going to learn several more code sections, but that's a good starting point to get at least 3 important ones under your belt. Now, also, to give you an idea, and I said this towards the end of last class as well, how the authors plural, lay out this chapter. They take code section 162A and look at the flush language, and then unpackages it by looking at code sections 182A1, 182A2, and 182A3. So, there's 3 different code sections that the authors are going to elaborate upon. But first and foremost, we're going to elaborate on code section 162A. If you want to open it up, not a bad idea. Everyone have code section 162A? There should be allowed as a deduction all ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business. Everyone see that language? And we have, and let it be known, this is a very well-known case. Welch v. Helbring is one of the 10 most recognizable cases in income tax, okay? And if you didn't catch it, it's authored by Justice Cardozo. And Justice Cardozo, just so you know, everyone has, most people have, several people have, their favorite Supreme Court justice, or whom they consider the best and the brightest. Justice Cardozo probably makes most scholars' top 5 list, just so you know, in terms of superstar justices, in terms of caliber. So just a little credit where credit's due. So Justice Cardozo ranks very high up there. All right. So, Angel, you have a chance to look at this? Frank? Andrew?
Yeah.
You want to tell everyone about the case?
Yeah, basically I think Welch was operating a company that went bankrupt, and I guess their debts were discharged at the time.
Okay, so everyone get the picture. He's operating a company, and as we know, companies generally have limited liability, right? That if the company has obligations and it goes defunct, some of you may have been at the other end of this, when a company goes under, you're out of luck, right? If the company owes you any money. Agreed? And in this case, the company went belly up and it stiffed a lot of people, right? And what does Andrew decide to do? Hey, Andrew, what does our taxpayer decide to do?
Well, he gets another job.
Right?
I guess starts earning money again, and then starts to pay off those debts.
It's beyond getting another job. I think he starts a new business.
Starts a new business, yeah. Yeah.
And he starts paying off the debt, right? The debts of this now defunct company. Everyone have the visual? And what would he like to do with respect to these payments?
Deduct.
He'd like to deduct them. Everyone got that? That whatever monies he expends, it doesn't matter if it's $1 or $100,000, he's paying off the creditors of the former company. And why is he doing this, Andrew? Is it a religious calling?
Why is he paying the debts?
Yeah.
Well, I guess he's somewhat liable to those debts, isn't he?
He's not, zero liability. Go ahead, David.
Strengthen his credit.
Oh, right, that's right.
When you say his credit, what, and Mike, were you gonna say something?
Preserve its reputation.
Well, I'm not so sure it is increasing his reputation, but with respect to this new business, he's trying to say, hey, we stand behind what we do. In other words, this business that I just created is a different kind of business. It's gonna make people whole, right? It's not gonna shortchange people, right? Sending a message to the business community that to be taken seriously, right? We have a word for that. In one word, what is he trying to do? Well, he's trying to deduct those expenses, but he's trying to generate, on the blank, goodwill, right? Goodwill. Everyone agree? He's not just doing this, again, because he's a religious guy or a moral guy, or, you know, he's weighing the benefits, the costs and the benefits of someone being in business, and he'd like to generate goodwill. Andrew, does it qualify under the prior version of Code Section 162 as being deductible?
No.
And if not, why not? Is it a necessary expense?
No. It's not ordinary necessary business expense.
So let's pause for a moment. Remember, the code requires the expense to be ordinary and necessary. Those are key phrases, right? The code, again, requires ordinary and necessary. If you look here, as Andrew's describing it, Justice Cardozo says the expenses are necessary, okay? As he describes the words necessary in the sense that they were at least appropriate and helpful, okay? everyone see on page 312, he said, the second full paragraph, he says that these were necessary expenses insofar as that they were appropriate and helpful. And he does point out in that same paragraph that the word necessary doesn't mean that the expense has to be habitual, okay? It can be a one-time payment and still be necessary. So if you operate a supermarket and someone slips on a banana peel and sues you for $5,000 and you pay them, the fact that that's the first time it's ever happened in your 30-year operations, right? Doesn't mean that, you know, that kind of expense can't be ordinary and necessary, because people routinely get sued, right, in supermarkets for banana peels, right? So just want to make the observation, the fact that it's a one-time payment doesn't necessarily mean it's non-deductible. But remember, it's a conjunctive requirement, right? It must be ordinary and necessary. We only met so far one of the two conditions, namely that it was necessary. What about the ordinary part, Andrew?
No, it's not ordinary. I think the commissioner basically said closer to capital outlay rather than
All
ordinary.
right, I mean, what Justice Cardoza says here is that this was an extraordinary, not ordinary, but an extraordinary expenditure, right? That people in Welch's position don't ordinarily pay off the debts of their old company, right? Everyone agree that last I checked, many of you might have been surprised to learn that here we have someone who's paying off debts they really didn't owe, right? It's extraordinary in nature. And he was not just doing it to fulfill something, let's put it this way. His objective was to obtain long-term goal, right? Long-term reputation goal, to build it, to cultivate it. And therefore, this expense has to be capitalized.
So,
Yeah.
quick question, what do you mean by long-term reputation?
I'm sorry?
What do you mean by long-term reputation?
Well, he's spending this money, say $100,000, and paying back old creditors because he's trying to build up, as we alluded to before, the reputation of the company he started, and also his own personal reputation. And in the footnote on the bottom of page 313, the Justice describes those expenses which are ordinary and those expenses which are extraordinary. All right? So this is our first case of an expenditure where, again, anytime you take money out of your pocket, it's good mental exercise, right? Wherever you are today, tomorrow, this upcoming week, the weekend, think to yourself, 162, 262, 263, right? Good exercise. And the author's on page 314. Go ahead.
If they're extraordinary, then they do not qualify as deductions.
No, they have to be capitalized. If you don't mind me saying this, Topel, and what gets kind of weird about this case, truth be told, it's very easy for me as a professor to say they have to be capitalized, and you guys to jot down they have to be capitalized. I suspect many of you just did that, right? Here's the question, right, Jacqueline? I bet you're thinking this, right? What does that mean in a practical sense? Think about it. Here's this guy starting this business, and let's just say he spent $100,000 and he's capitalizing the costs, okay? What does that mean in a practical sense? So your client says, okay, I know you read Welch v. Halvering, and you say I have to capitalize this. Okay, tell him or her what you should do next? Anyone have an idea? Because this really doesn't jump off the page. Any thoughts here?
It has a guess on it.
I'm sorry?
It has a guess on it. It was capitalizing, and we're gonna actually capitalize it as goodwill. This is,
And what does that mean, capitalize as goodwill?
so it's an asset on the balance sheet.
It's an asset on the balance sheet, and can you amortize it?
Well, this was back in 1933, so
Yeah.
I'm assuming you could back then, but can't anymore. Before,
I don't think you could back in 1933, I don't think you can now.
well, it was from impairment.
If you buy goodwill, purchase goodwill is amortizable over how long? I hear someone whispering. 180 months. What's your authority for that? Code section 197. Okay, code section 197 says if you purchase someone's business and part of the business price allocation is to goodwill, and we'll learn more about this in 2-3 weeks, you can advertise it over 15 years, okay? Amortize it over 15 years. That's purchase goodwill. This is self-created goodwill, right? He's not purchasing it, right? He's trying to create goodwill. We just spent $100,000, so this just gets booked on the company's balance sheet as goodwill, and it's gonna sit fallow there until the company is sold or liquidated, right? I'm just making an observation that this is not gonna serve much purpose. It's like a sunk cost. It's just gonna be booked on the company's balance sheet, but that's it. Everyone agree? Not gonna have much tax utility until such time as the company is sold. We have two problems on page 314. Taxpayer is a businessman, local politician who is also an officer director of an SNL association, which he was the founder. When partially due to his mismanagement, the SNL began to go under. He voluntarily donated $500,000 to help him bail it out. Is the payment deductible? Right. Mom?
Isn't that just like attributed capital?
You mean, that would just be a capital contribution, there's a
Yeah.
code section 118 that deals with capital contribution. So he could, in your opinion, he couldn't deduct it, and you might say, akin to Welch v. Helbring, right? You might argue, hey, this is a capitalized expense. Everyone agree? It has, right, some other kind of a aroma of Welch v. Helbring. Now, Elizabeth, would you agree or disagree?
I disagree, I think we should be allowed to deduct it.
Why?
Elmer W. Conti versus Commissioner, because he tells you to read that case, and that case is exactly about someone who was also, worked at a similar facility and was able to spend the money that they used to make sure that the financial institution.
They were able to deduct it, right?
Yeah, they were able to do that.
They were able to deduct it. Now, why do you think they were able to do that, Elizabeth, in that case, but not in Welch v. Helbring? What's the distinguishing factor?
Well, the business was running, it was still active, and this particular person was maybe a driver for that business versus Welch, whatever that one was. The business was already closed, you had already disposed, there was no need for him to pay those debts that were already canceled.
Well, I mean, if I could make a global point on this. That one really salient difference between the two is that with respect to Welch v. Helbring, that was the commencement of a new business. Everyone agree? He began a new business. And just to give you a little bit, again, foreshadowing, we're gonna look at code section 195. Code section 195 deals with startup expenses. Startup expenses have to be amortized over how long? 180 months, just like any intangible. So that has the aroma of being a startup expense. By contrast, as you were pointing out, Elizabeth, this is an ongoing enterprise, right? He's trying to salvage an ongoing enterprise. And that's an important distinction. So if you're trying to salvage an ongoing enterprise, what otherwise might be an expense that has to be capitalized, this is more in the nature of trying to keep it afloat, keep it going. That was held to be deductible. Okay, close case, but it went on the side of being deductible. By the way, if you checked your email about 20 minutes before class started, there's a brand new case where, I haven't taken a close look at this, where apparently some folks at the claw, there's a new tax court case. And if you remember my misgivings about the Stanton decision, if you remember, that was the case tied in with Duberstein, and the Reverend got thousands of dollars, and the question was that a gift? Was that compensation? And it was ultimately held to be a gift. At least preliminarily, the fact pattern in this case looks very similar, and the court held that it was not a gift, that it was taxable compensation. So I just thought you might find it interesting. Just a brand new tax court case that came out. Question 2. Consultant with ordinary necessary expenses incurred ordinary and necessary expenses on a business trip for which she was entitled to reimbursement from client upon filing an expense report. However, consultant did not file the report and was not reimbursed, but instead deducted her cost on her income tax return. Is that a 162 expense? Can she take that? Ning, what do you think?
I don't think it's a 162 deduction.
So you don't think she can?
Right.
Why?
I saw if you deduct so is it, I saw that's subject to a 2%.
Well, that's a different issue. That's under Code Section 67. Just so you know, this would constitute a miscellaneous itemized deduction on your tax return. But also recognize that Code Section 67G right now limits miscellaneous itemized deductions. You cannot deduct any miscellaneous itemized deduction until the year 2026. So, Ning, even if the taxpayer theoretically could deduct this, can't do it right now for a few more years. But I'm just saying, could this be a legitimate 162 expense? I have a feeling Elizabeth read this case too, right, Elizabeth?
No, it's not deductible.
And Elizabeth, see, Elizabeth's on top of the game. Did you Google the case?
Sunday was your class.
It's such music to my ears. He's just trying to make my heart get very soft here, up here. That's okay, you can do that all the time. All right, so talk to us, Elizabeth. By the way, just for the rest of the class, did you Google it, or did you go on to a tax research library?
No, I Googled it.
Okay, I'm telling you, virtually all these cases, you can just pick up off Google. It's not like you need a special tax library to get access to it. Go ahead.
Based on Haley, based on Commissioner, it says that the expense should have been on the clients, not on the, it gives a different tax result because they need to go under the client's expenses, not theirs, and because they didn't do that.
Well, let's just ask, most of you, many of you, I should say, work for companies, and when you incur expenses, say at meetings and whatnot, you get reimbursed. Is that a fair statement that most of you, you're supposed to submit your receipts, you get reimbursed, okay? Is there anyone here who takes a different path and says, you know what, I'm not gonna submit this, I'll just, let's say it's the year 2017, I'll just take a deduction on your tax return. Anyone do that? And why not? Amanda, you were gonna say? I mean, why wouldn't you?
The case was about that this person decided that he was only going to expense everything else travel lodging, but not the personal use of his car when he was on business. And no one had that rule or followed that rule. You know, he tried to claim it on his tax returns, and it was brought to court in US.
Well, I think, remember, we when you submit it to your employer, and let's suppose the cost, let's just use a number, $1,000, right? You have $1,000 worth of expenses you want reimbursed from your employer. Okay, you're gonna get that reimbursed, assuming it's legitimate. Your employer is gonna give you the check because, hey, this was to further business, and that's why your employer is gonna give you $1,000. It wasn't like you were going to a ball game or something, you were going to a meeting, and that's why you had to go 2 nights at a hotel, and you incurred those expenses to promote the business. And you're compensated dollar for dollar. If you try to take a tax deduction and your marginal tax rate is 40%, how much are you saving? Well, you're only gonna save 40 cents on the dollar, right? So if you have a $1,000 expense, you're only gonna be made whole as to $400. Everyone agree? So the fact the taxpayer is looking to, and that, by the way, gets worse, because now, under, it's not even current law, under 2017 law, you can only deduct that which exceeds 2% of your AGI. And in the year 2018, you couldn't even deduct it, so you got all these issues. But my point is, no one who has a real legitimate business expense where your company has a policy to get reimbursed would ever take a deduction in lieu of getting it reimbursed. It suggests that the expense was not legitimate, right? Everyone agree? There's something else, some other agenda going on here, which detracts from potentially the legitimacy of the expense. Another way of framing this is it probably was not an ordinary necessary expense, right, under 162. And since Elizabeth raised it, and since I didn't, after my little summary, about weekend events, so I get to ask people, anything interesting this weekend? Any movies, cultural events? Anyone do anything worth sharing with the class? Nothing? Aside from Elizabeth working hard, some of you probably watched the World Series, right? And nothing? Go ahead, Kim.
It wasn't on the weekend, it was Friday, it was leading into the weekend. And I did use one of the court cases.
Which court case? See, that's even more music to my ears. Which?
Versus Lucas.
Lucas Fiorello?
Yeah, Luke, yeah.
CEK, she was the head of
I
the
was
party.
pretty sure I was correct on that answer.
All right, so there you go. Lucas Fiorello, she name dropped on a Friday night.
Yeah.
I don't know if any of you can beat that in terms of weekend entertainment. Right, no one else did anything interesting? I happened to be in with my wife in Durham, North Carolina. I beat the storm, and I got the chance to get to the Duke Garden. So if you haven't been there, if you have, great. If you haven't, add that to your bucket list. Very, very exquisite gardens if you haven't been there. All right? So that was my foray into the weekend. All right, ready? Back into page 314. All right. So the authors are going to explore page 314, 162 versus 263 expenses, and talk about the fact that the regulations that are voluminous, they try to summarize and distill beginning on page 315. All right? And we're going to try to take a look at, beginning on page 315, amounts paid to acquire or produce tangible property. Generally, when you pay to acquire tangible property, the cost has to be capitalized. And there's a case on beginning on page 316, and we're going to see this come up again and again. If you look at the first full paragraph, it's entitled Commissioner v. Idaho Power. Everyone have that? Everyone see it? It's like 5 or 6 lines down on page 316.
Got it.
Got page 316. You see there's a case reference, Commissioner V. Idaho Power, associated with footnote 12. Okay? Let me just give you a quick summary of what this case stands for, its proposition, where this might come up. Suppose you're in the construction business, right? You're in the construction business. And as part of being in the construction business, you build your, let's just suppose I use Donald Trump, right? He's in the construction business, he builds hotels. And he builds them for himself, he builds them for others, right? Suppose he decides he's gonna build himself a new headquarters, right? Everyone have the visual? And he, as part of building this new building, he's gonna purchase, or his company's gonna purchase, those big, big dump trucks, right? And each dump truck costs $1 million, okay? The ones with the wheels the size of human beings, you've all seen those big dump trucks, right? And each dump truck, or the dump truck that the company uses, is gonna be on premises for 1 year. And the depreciation deductions associated with that dump truck, just to keep the number simple, $100,000 per year, right? It's a dump truck. And by the way, what kind of asset is this dump truck? Put a name to it. It's a depreciable asset. Say again, Vikram?
It's a depreciable asset.
It is, but put a better name at the water cooler. Kenji, you would call it what kind of asset?
Capital asset.
Capital asset. 1231 asset. It is not a capital asset, okay? You're killing me up here. 1231, everyone agree? And by the way, can't resist asking because it's in my DNA. Francis, if I say 1231, what code sections immediately fire in your brain?
1231.
Peanut butter and jelly, keep going. Francis, what to a code section?
1239. 1249.
And?
1250.
Right, everyone got that? So if I say 1231, everyone's instantaneously thinking 1245, 1250, right? Keep it that way. Keep those synapses firing, guys. You gotta think that way. All right. So we have this depreciable asset, and this big dump truck. Donald's gonna use it 1 year to build this new building, okay? And it normally would have $100,000 of depreciation. And over how many years do you depreciate a building, a commercial building? 39. What's your authority? Code section 168C. Code section 168C, you depreciate buildings over, commercial buildings, 39 years. Residential buildings over how many years?
7.5.
You think I heard it?
27.5.
27.5, right? Again, same code section, 168C.
Depreciate buildings over 39, you said? Or-
Commercial buildings, 39,
Okay.
residential, 27.5. The question is, and I'm oversimplifying, but not by too much. I'm saying, I could use real numbers. Trucks are depreciable generally over how many years, just so people know? Generally over 5 years. And, and this is $1 million truck, and because of something called the half-year convention, so normally this truck, the first year of depreciation would be $400,000. Because of the half-year convention, it would be $200,000. So the question is, can you get a $200,000 depreciation deduction, or okay, everyone agree that just assume I'm right for the moment, and I'll prove this in 2 more weeks, that the first year of depreciation on this big dump truck would be $200,000, okay? Or can I take, as a taxpayer, $200,000 deduction, or alternatively, do I have to capitalize that $200,000 into the cost of the building? Does Donald have to capitalize that $200,000 cost into the building and then write it off over 39 years? And the answer is? Brian?
Yes.
Yes, as in the latter, right?
Right.
What's your authority?
Commissioner versus Idaho Power.
Idaho Power. Commissioner v. Idaho Power. Okay? Court rules, Supreme Court no less, rules that you have to capitalize the cost of that depreciation expense, which makes sense. Because if Jay Solid tried to construct a building, I wasn't Donald Trump. I don't own a construction business, right? And I hired Donald Trump to build that same building for me. What would he do regarding that dump truck? He would say, you know what? When he's figuring out the cost of what to charge me to build that building, he'd say, you know what? I gotta buy a new dump truck and I'm gonna lose approximately $200,000 for the value. I gotta put that in the cost of the building, right? So that would be a built-in cost of the building among many other things. And when I got title to the building, embedded in whatever my purchase price would be, I would then depreciate it over 39 years. Agreed? So the Supreme Court is essentially saying whether you self-create an asset, or alternatively, you use a third party to create the asset, you should be on par. Everyone agree? So the fact that Donald Trump, created his own asset should not enable him to accelerate his expense. And the fact that I had to use a third party to create the asset shouldn't have put me at a deficit. So Idaho Power is the takeaway on that. It memorializes that outcome. I'm sorry? You're good? Okay, beginning on page 317. There's a discussion of repairs versus improvements. And there's a discussion, and this is introduced by this case, Midland Empire Packing Company, the commissioner. I don't know if right. So Matt, do you have a chance to look at this?
I did not.
Good. Okay. Andy, did you? Okay, talk to us about it.
So this company, they built a concrete lining.
But before they get to building a concrete, give us a little bit, I'll help out. Before they get to building a concrete lining, what was going on? Why did they need to build a concrete lining?
Their neighbor had an oil spill.
Well, what did this taxpayer do? What did this taxpayer, because that's important to say. I don't need all the facts, okay, guys? I just need the most elementary facts, and I'll try to help you out here. Say again, Jacqueline?
Cure ham and bacon.
Cure ham, it was a slaughterhouse, right?
Yeah.
So they apparently, right, in the basement of this building, have lots of meat hanging down, right? Or they were using it as storage. And what was the issue, Andy? From one of the neighbors, what was going on? Oil was permeating everywhere, right? Did not paint a pretty picture, right? You carnivores out there, it's not looking pretty, right, Jacqueline? It didn't sound like the place was being closed during the time the oil was seeping into the walls, right? At least I didn't get that sense. So what happens, Andy?
They decided to build like a lining.
Okay.
From coming in.
Yeah, they decide, the taxpayer decides to expend money. They're gonna build a lining, okay, excuse my graphics here. Some sort of lining to protect against the oil seepage, right? Everyone got it? And what's the issue the court has to address, Andy?
Well, they deducted as ordinary.
Okay, well, that gets to the issue. Does this expense, can this expense be deducted? Or alternatively, what? Or it must be capitalized, right? Isn't that the issue? And what does the court, so everyone get the visual. Was this a repair or an improvement? If it's repair, deductible, code section 162. If it's an improvement, probably has to be capitalized under code section 263. All right, Andy, what does the court say?
Well, it is a repair.
Well, you're saying that in a conclusory fashion. So, look, Andy, I'm not disagreeing. The court concludes, right? Deductible as a repair. And on what basis does the court decide that? Elizabeth had a busy weekend. She had her hand up before, so
I can tell you if you want.
go for it.
Okay, they decided that it was a repair because, first of all, the meat inspector had told them that if they didn't fix the problem, they were gonna get shut down. So they had to fix it in order to stay, open for the business and be able to keep business as they were. The repairs did not enhance the place, they only fixed.
Did not increase the value.
Did not increase the value.
Okay.
Did not enhance it, did not, they were being used for the same purpose, they didn't change the purpose of what the basement was being used for. And, for those reasons, it was deemed a repair and not a, capital expenditure.
Okay? Andy, you're on board with that? So, this expenditure did not materially increase the value of the building. Although it gets a little bit tricky, because if the oil continued to seep, if this building were worth $100,000 before the oil seeped, right, everyone agree, if we made the value hypothetically $100,000, and then the oil started seeping, maybe the building's worth $40,000, and now when we put the plastic lining, it's worth again $100,000. But you can see, it does increase the value, but theoretically it doesn't increase it beyond the initial $100,000, right? And then there's a case mentioned on page 321, under the note. Everyone see the first paragraph there? Mount Morris Drive-In Theater? Jonah, you remember what happened here? Jonah, do you see that?
I'm trying to find it because I have an old book.
Oh, you have an old book,
So
okay.
I gotta go through it.
Yeah, it's in the old book, but I don't know what page it's on the old book.
Yeah, I know.
Tuval, do you see that? Do you remember? Ron? That's her, Perla? Mike? Do you remember what this case was about? Kim, you were gonna say something?
Yeah, I read that, the little snippet of
A
it.
little snippet. What happens
Yeah,
here?
basically, they installed the drainage system.
Okay, so we have a movie theater, okay? I don't know when the last time anyone in this room went to a drive-in movie theater? Anyone been recently to a drive-in?
Do they still, like, use drive-ins?
I think there's one or two in New Jersey still. I'm not sure, don't quote me on that.
I haven't seen much lately, so.
Yeah, I think you can Google that, I don't know. Patrick, you wanna Google that, see drive-in movie theater, New Jersey? I think there's one in Andover, New Jersey, I don't know why I think that. Anyway, hold on, Patrick, any driving?
Yeah, we got one in Warwick, and then,
Where's
Vinland.
Warwick? Where?
Vinland? Oh, Vineland.
Where's Warwick?
right over the border. Like if you take Sussex and you go up into New York.
So it's not in New Jersey?
No, it's New York.
Okay. And Vineland's like really southern near Camden, right?
Yeah.
Right, so not the easiest date night, right, to go to a drive-in movie theater. All right, so drive-in movie theaters can create runoff, and here we have a drive-in movie theater creating a lot of runoff, and the neighbor says, you don't fix that runoff, we're gonna sue, and they have to install drainage, drainage pipes, right, to stop the runoff. And the question is, Tim, how is that treated for tax purposes?
In this case, it was actually opposite of Midland, it actually been determined that it was a capital asset.
Here it was determined it was a capital asset or a capital improvement, right? And the cost had to be capitalized, it was not deemed a repair. And at a quick glance, it's not always easy to distinguish between these cases, right? Here, we're protecting oil from seeping in, eligible repair. Here, we're trying to stop water from seeping out, right? As the drainage pipes would be considered a capital expenditure. Now, here again, if we said that the movie theater originally had paid for the parking lot, say $100,000, getting back to our $100,000. Someone can come and purchase this property, and now because of climate change, there's a lot more moisture, and the moisture is causing runoff, right? Truly a possibility with climate change. The question is, what's going on with like this expenditure? Let's say the expenditure was $20,000. The court is saying you've got to capitalize that, so now your basis is going to go up from 100,000 to 120, right? Does that make sense? And I think it does, because this person, whoever paid for this parking lot, now it's an improved parking lot. It's more valuable, right, than a purchaser, because you're not causing problems to your neighbors for which you can be sued. So you can probably command a higher selling price. Where in this case, you were just trying to get back to where you started from. But it's not easy. I don't want to tell you, oh, this is an easy case. You can quickly distinguish between the two, but arguments can be made. And that's why the authors do this. They juxtaposition these two cases because they are hard to read. So you guys check it out. Beginning on page 322. And if you do have, by the way, let me just say this, even at this stage of the course, if you have an 18th edition, like Jonah, what you might consider doing is finding someone during the break who has the 19th edition and sitting very close to that person, so that as I make page references, that you can easily or more easily find yourself. I don't want to claim that the 19th edition is vastly different from the 18th edition, but just to orient yourself, so Jonah and others who have the 18th edition, again, you may want to sit very close to someone who has the 19th edition, just so that, again, you can find out where you should be. So in the 19th edition on page 322, the second full paragraph, it talks about what is an improvement in that second full paragraph. And it sets up 3 different conditions that could be met for an improvement. Result in a betterment of the property. And it defines in the paragraph that follows what is betterment. 2, it restores the property. And then the next paragraph below that, that goes from page 322 to page 323, discusses what is a restoration. And 3, adopt a new or different use that's spelled out on the first full paragraph on page 323. So what the authors do is they're trying to summarize some of the salient aspects of what is the difference between a repair and an improvement. Right? And I'm just gonna, one or two things I want to call to your attention. If you look on page 324, right after footnote 22, it says, expenditures made to enable the taxpayer to use the property for that expected period and for the planned purpose generally should be a deductible expense, or should be deductible expenses. So again, expenditures made to enable the taxpayer to use the property for the expected period, not to elongate the period, okay? If you make an expenditure to elongate the period in which that property can be used, that has the aroma of being an improvement, capitalizable, but if you're just trying to get that property up for its expected use, and for the planned purpose, you're not changing the purpose for which that property was to be used, should be a deductible expense. Okay, and then the paragraph that begins, 2 below, the challenge, and if you go 4 or 5 lines from the bottom, it says, regarding the Mount Morris case, the construction of a drainage system would likely constitute the production of tangible property or be a betterment to the building because it ameliorates. The word ameliorate is a good SAT word. It means improves, right? It improves a pre-existing material condition or defect. Thus, the cost would likely be treated as a capital expenditure. Okay. Anyway, we're going to go through a few examples before the break of what is the difference between an improvement versus a repair. So hold your thoughts on that. If you look on page 325, and I just want to call your attention to, keep in mind on page 315, the heading is entitled Amounts Paid to Acquire or Produce Tangible Property, versus on page 325, the heading is Amounts Paid to Acquire or Create Intangible Property, okay? So just, the authors don't do such a great job on this, just trying to highlight. The first part deals with tangible property, stuff you can touch, versus intangible property, stuff you can't touch. And the question is there a different tax treatment depending on whether the property is tangible versus intangible? And regarding intangible, we have this Exacto case, which is fairly well known. We have a company, Unilever, which is looking to take over National Starch. National Starch is also known as, AKA, Exacto. Okay? So we have one company, Unilever, looking to take over another company. And National Starch, or again, Exacto, incurs lots in the way of legal fees and other fees associated with this takeover. Okay. They paid an investment banker $2.2 million, and they paid legal fees of $500,000 and other expense. So let's just say it paid $3 million to facilitate this takeover, okay? So this company incurs $3 million of expenditures relating to this takeover. And the question the court has to address is on that company's tax return. What do you think the issue is? Since we're in chapter 14 of the textbook, you guys don't have to. Is it deductible, right? Isn't that the issue du jour? Is it deductible? Right, big issue. Is it deductible? Now, I will give you some, I'll call it, backstory of this case as told by, okay, not firsthand, but some of you, maybe, I'm not sure, did any of you have federal tax and procedure yet? No, okay. But the person who teaches that course, Richard Sapinski, he works at the law firm of Sills Cummins, which is about a half a mile from here, right on McCarter Highway. And he argued the initial case for the IRS. He used to work for the IRS, and he argued the original Exacto case on behalf of the IRS. By the way, some of you might have seen Richard Sapinski, where he has had a whole slew of people he has defended. And most recently, so he does a lot of white-collar tax work now. Some of you have seen his most recent client. I don't watch the show. You guys will have to help me. The Situation. That guy. What show is that? Jersey Shore. Anyway, this was not Rich's finest moment because I think he's now going to jail. The Situation. Is that right, Matt?
Yeah, he was going to jail for like 2 years.
Okay, because he was convicted of tax fraud. All right, so that's one of Rich's clients. But why am I telling you this? Because he argued the case for the IRS. And originally, as told by Rich, that the IRS was considering settling with this, settling the matter, striking a bargain with the taxpayer. And Rich, if you haven't met him yet, is a kind of low-key kind of guy. And at the time, this goes back many years ago, much younger, and might have projected a kind of greenness about him that, gee. And can you imagine the law firm that, in this case, National Starch and Dopco hired? They probably hired the best law firm, scattered arcs. You can pick your New York law firm. And they took one look at Rich and said, you know what, we're gonna make mincemeat out of this guy, and we're gonna destroy him in tax court. But that was a great underestimation because Rich is really, really good. And he brought the case for the IRS. And if you recall or had a chance to read, what happens to the taxpayer in tax court? Taxpayer loses, okay? This was David versus Goliath, and David handily won against Goliath, okay? And if you ever want a story or two, you don't have to hear it from me, but if you take federal tax procedure with Richard, you can get the case firsthand. In the appeals court, likewise, the IRS wins. Why was the taxpayer adamant that the taxpayer should win? What was the taxpayer's strongest argument? That the on what basis did the taxpayer say, have it? Do you recall why the taxpayer said, taxpayer should win. No, Patrick?
Wasn't it that they didn't create like an asset,
Okay, so what case did the taxpayer rely on, do you recall?
linking savings?
Yeah, look, taxpayers are like judges, or taxpayers, this notion of stare decisis, that courts like to follow what other courts have done. So the taxpayer said, look, Supreme Court, there's a case called Lincoln Savings, and in Lincoln Savings, you said that if there is a tangible, if there's some sort of asset which is created, in other words, if you spend money and you create an asset, you have to capitalize the cost, okay? Here are the taxpayer's logic. Taxpayer says, if you spend money, Lincoln Savings stands for the proposition that if you spend money and there's an asset created, whether it be tangible or intangible, you have to capitalize the cost. And the Supreme Court has no problem with that. The Supreme Court says, yes, we agree. And if you create a separate asset, okay, it has to be capitalized, okay? On the other hand, the taxpayer says, if there's no separate asset created, conversely, if there's no separate asset created, the expense should be, you should be able to take a deductible expense. Everyone understand the taxpayer's logic? They say, if you create a separate asset, capitalize. If there's no separate asset, deductible. Seems attractive on its face, right? Very simple, right? And certainly I'm one. I like simple rules, right? So that resonates with me. But is that a fair reading? Because the Supreme Court looks at the taxpayer's analysis, and the taxpayer's analysis, in a nutshell, is spelled out on page 326, the first full paragraph. Towards the second half, says, in doing so, the Court of Appeals rejected National Storage contention that most of the disputed expenses did not, quote unquote, create or enhance a separate and distinct additional asset. They could not be capitalized and therefore were deductible. So what the Supreme Court has to do, and again, on the top of page 328, the first full paragraph, National Historics contends the decision of Lincoln Savings changed these familiar backdrops and announced an exclusive test for identifying capital expenditures, a test in which, quote unquote, creation or enhancement of an asset is a prerequisite, a sine qua non, meaning it's essential to capitalization. And deductibility under 162 is the rule rather than the exception. So they keep emphasizing that. But the Supreme Court says to the taxpayer, no, you got it all wrong, buddy. That's not what we said. We said, yes, if it does create a separate or distinct asset, yep, you got to capitalize it. But you're reading too much into the case. We never said the converse is true. And that being the case, anytime you have an expenditure, and in this case, this is a $3 million expenditure, and there's significant future benefits, that cost has to be capitalized, right? Because you're making an expenditure, and in this case, a pretty large one, in which your expectations are that this is going to serve you well, this expenditure, for years and possibly decades to come. And if you recall, this was a friendly takeover. This was not a hostile takeover, right? The $3 million that was expended was to facilitate this takeover. And why was this money spent? It was to enhance the profitability of this company for the next decade, right? They spent this $3 million under the auspices that by spending this money, this company would grow larger and be more profitable. So, has the aroma, that was me taking a deep breath, trying to show that the aroma was that of, hey, this has a smell of capitalization, right? Because those expenditures that you capitalize are typically those that have long-term benefits, right?
Professor,
Yes.
just a regular question. What if the company was, instead of a for-profit company, it was a non-profit? Then you basically adding on your balance sheet, you basically inflating your assets and.
But keep in mind, not-for-profits are found under Code Section 501c3. They have to file every year Form 990. And you don't have to be responsible for this, but there's code sections that deal with, under Code Section 511, unrelated business income, UBIT income, okay? And I can't answer your question, because if the not-for-profit is making the expenditure, I'm not sure under what pretense is it doing it. Is it trying to gain more UBIT income? I don't know, Tupal. So, I mean, that's a debatable issue. Let's just keep in the for-profit sector. There's a whole regime for not-for-profits. It's a very different regime than we're going to discuss. Okay? If you read this, and I encourage you to, taxpayer loses, and it causes, how do I say it? Causes tremendous uproar in the tax community. Because remember, this is not Congress writing statutes. This is the U.S. Supreme Court saying, hey, if an expenditure has significant future benefit, you have to capitalize it. Pause for a moment. A lot of expenditures have that aroma. And a clear example, for example, many accounting firms they spend money on continuing education classes. Okay? So you guys decide, some of you, I hope all of you, to come November 9th, right? To this alumni event, okay? And your firm expends the $35. And they're hoping that you will really learn about Code Section 199A and qualified opportunity zones, and you're going to take that knowledge with you and use it for the next several years, right? Because you're going to solidify your base or your knowledge base in this area. Arguably, that cost should be capitalized, right? So I'm just pointing out that in DOPCO, there's no natural boundaries to the test enunciated by the Supreme Court of saying significant future benefits. And that got a lot of people in the tax community unnerved. The IRS, soon after DOPCO, notwithstanding it was a great IRS victory, the IRS had to pull back. And through a series of announcements and revenue rulings, essentially said, yes, and DOPCO was a favorable case, but don't read between the lines. We're not going to push an agenda unless taxpayers are over the top, okay? So just sharing with you, and in the note that follows, our authors point that out, and then regulations ultimately were issued, okay? And if you look on page 332, the first full paragraph, these regulations generally require capitalization of an amount paid to acquire, create, or enhance an intangible asset, an amount paid to facilitate an acquisition or creation of an intangible, and 3, an amount paid to facilitate a restructuring or reorganization of a business entity. Okay? So you guys, the authors elaborate a bit what that means. And we'll see in a question, I'll call to your attention how this pans out, that the regulations actually curtail in DOPCO in unanticipated ways. So let's hold that thought for a second. Let's look at the problems on page 334 and see where this goes. Landlord incurs the following expenses during the current year on a 10-unit apartment complex. Each expenditure is currently deductible. Is each expenditure currently deductible repair or capital expenditure? $500 for painting 3 rooms in one of the apartments. So label that as deductible, or if you have to capitalize that expenditure. So Ben, Rudy, Paul, what do you guys say?
Is that improvement?
Say again, Rudy?
Improvement?
So you would capitalize it. Paul?
Enhancement?
Let's get away from adjectives and just call it deductible or capitalized.
I would say capitalize.
Ben?
Yeah. Capitalize it.
Capitalize, anyone in the big room?
Over deducted, it's a repair.
Repair?
Mm-hmm.
Matt, you saying what?
I agree, it's over deducted,
Why?
because it's not improving anything, you still have to paint the wall, you probably have to paint the walls again in a year, you know, it's general maintenance.
You're a great landlord if you paint the walls every year. What building are you in? I want to move there. That's, haven't met those landlords yet. All right. Now, see, I like this because it's emblematic of how challenging this can be. I think 99.9 of accountants out there and taxpayers would deduct general painting, okay? Now, context matters. So, you know, you get new tenants, you're just sprucing up the place, okay? It has the aroma of just being a general repair. If, however, context matters, if it's part of an overall remodeling of the whole building, okay, then you would have to capitalize it, right? So, remodeling, capitalize, but if it's just repainting a few rooms, generally constitute a repair, right? And keep in mind, excuse me, every repair adds value, right? When you fix the kitchen sink that's not working, the kitchen sink that isn't working isn't worth much, right? But when you fix it, it's all of a sudden functional. Tim?
Quick question. So it wouldn't matter the type of building, because I know in one of my friend's building, she's been in for.
Doesn't matter what kind of building.
She's been there a lot of years, so she has an old apartment, but she went into one of the apartments they were renovating, took the walls down.
Well, then if they're remodeling, you gotta capitalize it.
Oh, gotcha.
Okay, things, it's different. Remodeling, again, context matters. How about $4,000? So again, my job tonight, guys, is not to make your notes ambiguous. I'm not trying to be equivocal up here. I'm just trying to point out these are challenging issues, and there are better answers. There's not perfect answers. Rudy?
So if the landlord painted all of the units, it would be,
If it was part of a remodeling job in general, like Kim was describing, I would say you have to capitalize it.
But it doesn't have to be all the units, it could be substantial number of units also.
It could be that, like one unit, which they're remodeling the whole thing, right? But if they just come in to paint 3 rooms, I don't think that's gonna put you in a situation you have to, I think most people would say just deduct that expense, $300. How about $4,000 for replacing roof over one of the apartments? The roof had suffered from termite damage. So in this case, Jason, EK, what do you say?
I would say deduct for general repairs and it's over only one apartment.
So, I'm sorry, you're saying it's what?
It's only over the one apartment with termite damage, so it's a general repair deductible.
Deduct, okay?
I agree with you.
Okay, anyone have a different argument, or everyone under the smoke?
I was just thinking, like, it depends on, like, the useful life, like, you know, how long will that repair, and how long will that replacement?
Repair's generally gonna extend the useful life, not always. I mean, here, they said the useful life was gonna remain the same. I agree, we want to consider that. And then we're told it's a 10-unit apartment complex, right? Like 10 units and one of the roofs are bad, but it could be a high rise, right? Where there's, 5 stories, and if you get the visual, I can't draw, but if you get it, where it's 5 stories high, and one half of the roof is bad, I could argue here, it's just a repair, right? It's just fixing 10% of the roof. Here, if I'm fixing 50%, 50% might be something where we have to capitalize it because it's going to extend the useful life, maybe the entire roof, right? So, again, I'm not trying to be purposeful, ambiguous here. Just saying context and facts matter, right? And that's why, by the way, you may have heard me say this before, but it's worth, again, this kind of thing, the repetition. Anytime a client asks me a tax issue over the phone, typically, I get this all the time, and they say, well, can you just shoot me an email with your answer? If you're willing to do that, and a lot depends, always restate the facts. Because if you just say to a client, oh, it's deductible, years later when I'm dealing with malpractice suits and being an expert witness, emails are extraordinarily dangerous. And if you don't anchor your analysis to a particular fact pattern, clients can make up the facts they want to say, oh, they responded to my question and they said it was deductible. But if you can write to the client and say, here is how I understand the facts, and elaborate, guys, and based on your understanding of the facts, you then offer your analysis, that's going to put you in a lot better position if and when there's a problem and the client's being penalized and they're saying you're the person who caused the issue. So just be careful about responding to emails. I mean, I'm stating the obvious, but we're all guilty trying to impress our clients, or at least, I'm guilty of that. And I'm saying this out loud to remind myself what I shouldn't do either. So just be careful out there. All right, question C. How about $1,000 for patching the entire asphalt parking lot? Deductible, not deductible. Let me ask Vikram what you say, Nick, what you say, and Annie, what you say.
I say it's not deductible.
Not deductible. Nick? So you would capitalize it, right?
Yeah, I'll capitalize it.
Nick?
I'll do it.
Okay, Annie?
Capitalize.
Nick? Other Nick?
I would deduct it.
Brian?
I would deduct that.
Wow, we got a mixed crowd here. Jacqueline?
Thank you, Doug.
All right, and why say deduct, Jacqueline?
Just patching.
All right, you say patching, and those who said capitalize, what word do you focus on, Vikram? Entire. Ah, these tricky authors, right? Because on one hand, when you use the word patching, it connotes, right, a repair, right? On the other hand, when you say the entire, it has a different aroma, right? So again, we like to know the magnitude of what's being done here. Everyone agree?
Professor, I'm sorry, just for exam purposes,
I'll be clear. I'll be clear, Simone. Fear not. Fear not. Fear. Let me rephrase it. I want you to fear because fear motivates us, right? Every time I look at client work, I have lots of fear, right? But don't worry because it will be clear, okay?
Be hopeful.
You hopeful?
Well, that's the religion, fear and hope.
Fear and hope. Fear and hope. Okay. How about $3,000 for adding a carport? And anyone who's not from the South will not necessarily know what a carport is. Anyone from the South in the room? Oh man, no one? No one's raised, not a single person. Southern New Jersey? Does anyone, Mike?
It's just a roof attached to the side of your house where you park your car.
Okay, so it's not a structure that has walls necessarily. I understand it's like 4 posts with a roof, right? Everyone get the visual? So our carport, but it's not like a little tent either. It's like a real structure, right? So if you Google carport and put in Google Images, you'll see what a carport is. So Mike, you're my closest thing to an expert. Deductible or not?
Capitalize it.
Why?
Because it's adding value to the property.
Yeah, it's a semi-permanent structure, okay? So in theory, you know, if you want to better protect your car, you have a carport put in, right? It protects it from the elements. How about $100 for advertising for a tenant to occupy an empty apartment? In that case, deductible or not? Annie, Angie?
I would say it's an advertising expense of deductible.
Deductible, Cam, agree, disagree?
Yes, I agree.
Okay, under what code section, guys? 162, right? Just a regular advertising expense. Question 2 says, are the regulations on capitalization of amounts paid to acquire, create, or enhance intangible assets consistent with the U.S. Supreme Court decision in Exacto? And just so you know, or just if you haven't had a chance to read the author's note that follows the Exacto case, the authors point out the critiques that the regulations often don't go nearly as far as the court case. That the regulations, in many respects, very narrowly portray the Exacto case. So the regulations are a pullback, and what that means is they're more pro-taxpayer, to the point where there's many academics who complain that the regulations are biased in favor of taxpayers. They're written too favorably. Question 3. Suppose the taxpayer in Exacto had performed some of the services in connection with the takeover itself, in-house. So instead of spending $3 million, you only spend $2 million, okay? Everybody have a visual? Instead of hiring outside people to do it, they hire 3 or 4 attorneys and they save $1 million in legal expenses, right? But they have to pay those salaries, right, of the lawyers they hire in-house. Would the regulations require those expenditures to be capitalized? And I don't know, Elizabeth, you had to look at that, because let's see how your weekend really was.
No, the way that it depends. It's one of those things that it depends.
Does it? Anyone read the regulations the authors cite us to, and can you deduct or must you capitalize it? Remember in Idaho Power with Donald Trump, we had to capitalize the cost of the dump truck, right? Everyone agree? The depreciation expenses. This is very similar insofar as instead of having a dump truck, we're hiring people for their services, right? And you would think under Idaho Power, if you spent $1 million in-house, right? You spend $2 million on outside counsel, but you spend $1 million on inside. Under Idaho Power, you would have to capitalize the $1 million, right? As if you hired, outside counsel to put, whether you do it yourself or you hire a third party, you should be on par. But what the regulations say, surprisingly, say you can deduct this $1 million. And that creates a rift between the creation of tangible property, which you have to capitalize, versus intangible property, which you don't have to capitalize.
So even if you hire lawyers just to do this project, I mean, you can still deduct that expense?
You can deduct it, again, which flies in the face of Idaho Power. Check out that regulation, the author cite you to. 263A-5D1 and 2.
This is only in-house.
This is in-house. Now, the authors say, compare that situation with the taxpayer who pays an employee in connection with the construction of a new building. Is the difference in results justified? And the answer is no. Or it should be no. All right, so what I'm going to do, if anyone's interested, just this is with respect to the November 16th event. If anyone's interested, I'm going to leave it right here. Just put your name on the back. That would be great. And we will see you back here in 9 minutes. So if anyone's interested in this event, signing up, please feel free to come. Look at Code Section 162A. Talks about ordinary necessary expenses carried on and carrying on any trade or business. So the authors are going to describe in the next section, what does it mean carrying on? What does the word carrying on mean? And we have Frank C. Commissioner. Okay, what is carrying on? So, Dane, you have a chance to look at this?
Oh, sorry.
Okay. I'm losing track of who I did or didn't call on. So, Amanda, you have a little chance? Morning, Frank?
Yep.
What's going on in this case?
So the Franks were looking into buying a newspaper or a radio station. So
Okay.
they were traveling around the US doing research, and they wanted to.
So picture if you will, you have a couple traveling across, what is it, Route 66? What's the famous highway? Is it 66? You know, going up and down, trying to find a newspaper, radio station they're going to buy. They are investigating whether or not to form this business. And what happens?
They were looking at deducting their expenses while they were looking to purchase one of the stations.
Okay, so they spend a lot of money and they would like to deduct the expenses. Are they successful, Amanda?
I don't believe so.
And why not? Why does the court rule, and you're correct, the court rules that these expenses are not deductible?
I think because the business wasn't already up and running, or
Right.
they had incurred the expenses.
You're not, to use the phraseology of the code, the taxpayers are not carrying on a trade or business, right? And if you don't carry on a trade or business, you're not within the scope of the statute. Everyone agree? The taxpayer loses. By way of contrast, if you have a business and you expand that business, so you're expanding an existing business, if you look on page 337, the information, second paragraph, last sentence, if Frank had been in a trade or business and was seeking to expand that business or some branch of it, his position would have been stronger. So there is a difference, like we discussed before, context matters. And if you have an existing business and you're expanding it, looking to expand it, should be deductible. Code Section 195 subsequently came into existence. Congress enacts Code Section 195. after the Morton Frank decision. So now taxpayers who have startup expenses have to capitalize those expenditures and then amortize them over 15 years.
Can you repeat that?
You have startup expenses, you have to capitalize them and then amortize them over 15 years. Now, Congress does permit, and this is not uncommon for the small businesses, taxpayers can deduct the first $5,000 of startup expenses. However, to the extent their startup expenses exceed $50,000, for every dollar that exceeds $50,000, they lose $1 of immediate deduction. So let's pause for 1 second. If your client has $15,000 of startup expenses, what can they deduct this year and what must they capitalize? So picture if you will, client has $15,000 in startup expenses. Francis, what does the client deduct and what must be capitalized? And Mike, see if you agree.
If they have 15,000, so all of it, they can deduct all of it since it's not over 50.
Mike, agree or disagree?
I would say you can deduct 5 and then you capitalize the next 10.
Is that all right? Francis, you only get $5,000 leeway.
Oh, okay.
Everyone agree? $5,000 you can expense, and anything above that, you have to capitalize. However, if you have a client who puts into service $51,000, everyone have the visual? They incur $51,000 of startup expenses. Okay? In that case, Leo, Nick, Andy, what does the client have expense? What does the client have to capitalize?
So he would still expense the 5,000 and then he would do whatever's remaining, so 46.
Nick, agree or disagree?
He would expense 4,000.
And capitalize what?
Was it 5,000?
We put $51,000 in startup expenses.
And capitalize the
47,000.
47,000.
Andy, agree or disagree?
He would spend 5,000 and capitalize the rest.
Capitalize the rest. David, final word, who's right?
Expense the 4,000.
To say it loudly, lots of people behind you.
Expense the 4,000.
And do what with the rest?
Capitalize.
Okay, look, if you put 51,000 into service, that means you exceeded 50 by 1, right? So you lose for dollar, $1,000 worth of deductions, right? You lose $1,000 worth of deductions, that means you can still expense 4, right? And the remaining 47,000 you have to capitalize, right? And expense over 15 years. So if we put $60,000 startup expenses, in that case, Ryan, what do we?
Capitalize the whole thing.
Capitalize the whole thing, right? Because we lost every dollar of our immediate startup expenses, right? All right, everyone got that? Employment seeking expenses, beginning of discussion on page 339. Talks about when you seek employment, what expenses could be deductible. And on page 340, if you go down 2 paragraphs, there's a discussion of revenue ruling 75-120. 75-120. Elaborates what's going to be deductible and what's not when it comes to employment expenses. Is it finding a new job? Is it in finding a new job in the same area of your prior employment? Is it finding, you're already working and now it's finding, again, a job in the same sphere of your existing expertise? Those things are spelled out. We don't get the whole revenue rolling year, but the authors do a nice job of elaborating what is or won't be deductible. You guys will have to read that. Look at page 342. Determine the deductibility under 162 and 185 of expenses incurred in the following situations. Tycoon, the doctor, unexpectedly inherited a sizable amount of money from eccentric millionaire. So when Tycoon inherits the money, taxable or not, when Tycoon inherits the money, say again, Jacqueline?
Not taxable.
What's your authority? 102A, right? You're thinking it, right? Right, Matt? Right at the tip of your tongue? What do you hear? All right, you're thinking code section 1014 as well, right? All these code sections coming together, but that's not the issue du jour, right? Tycoon decided to invest part of her fortune in the development of industrial properties. She incurred expenses in making a preliminary investigation. Is that, Abed, deductible or not? Patrick, see if you agree. Deductible, Patrick?
I don't wanna say it's not deductible.
Why not?
Isn't that sort of like the Frank case?
And what do you say, Dave?
I think it's 195.
And has the aroma of being a startup expense in the year 2018. Everyone agree? I don't think you can just deduct this. No, we're not carrying on a trade or business. We're doing akin to investigation. Vikram, you were going to say?
Yeah, I was also gonna agree with them saying it's not deductible,
Okay.
because it's not a business.
How about B? The facts are the same as A, except that Tycoon, rather than having been a doctor, was the successful developer of residential and shopping center properties. So in this case, Nate, Alvin, what do you guys say? Deductible or not?
I think it's deductible, but also depends on the
Depends on what?
how much expense.
Tell me how that would change your outcome. And
Is that
Alvin.
Is that considered start-off expense?
Right, I mean, you're talking about the 5,000, so you're calling it a startup expense, right, Nick? Alvin, agree or disagree?
No, it's not deductible.
You say it's not deductible, you have to capitalize it. Kit, final word?
Sorry, I don't have the text in front of me.
I'm sorry?
I don't have the text in front of me.
Go to the textbook, Frank?
I could see how it's a startup if he's already doing residential and shopping center, and this is an industrial property. So it's expanding, but I might be reading.
So if it's expanding, it's not a startup expense, it would be immediately deducted, right? Everyone agree? So in that case, and I think it's a fair statement that this would be an expansion of an existing business, should be deductible. And the authors make note of that expansions are generally deductible as compared to starting up a new business enterprise. So I would shy away about the issue of the first $5,000 here. How about question C? The facts are the same in B, except that Tycoon, desiring to diversify her investments, incurs expenses in investigating the possibility of purchasing a professional sports team. Okay? So in this case, there's a diversification element to it. Ron, what do you say in ProLab? Deductible or not?
Deductible?
Okay.
It's not a business?
I'm not quite sure. Because it's not a business, it's deductible, are you saying, Ron? I'm not sure how that logic fits here. Perla?
I will capitalize it, because it's not like on the same lane as the previous business.
So what do you say, capitalize or
Yeah,
expense?
no, capitalize.
Capitalize, Vikram?
I said, it's not expansion of an existing trade or business, therefore there's no deduction.
So there's no what?
There's no deduction.
So what would you do instead?
You would, capitalize it.
I mean, it does look like, Ron, a startup expense. I don't know how else, because this is starting a new line, right? They're looking to diversify, start a new business. It's not an expansion of a continuing business, right? Question D. The facts are the same as C, and Tycoon purchases a sports team. However, after 2 years, Tycoon's fortunes turn sour and she sells the sports team at a loss. What happens to the deferred investigative fees here? Angie, Nick, Leo, what happens? Suppose she spent $2 million and now she amortized the deductions and now she has 1.7 million in expenses she has not deducted yet. What do you do with respect to that? Simone, what's your hand
I
up?
was gonna say, how do you write up the expenses?
What's your authority? Just got reaction? Nick?
195B2.
195B2. Take a look, everyone. Quotation 195B2. In the case in which a traded business is completely disposed of by the taxpayer before the end of the period to which paragraph 1 applies, any deferred expenses attributable to such trade or business, which were not allowed as a deduction by reason of this section, may be deducted to the extent allowable under Code Section 165. So there's the bridge, Simone, that you needed. That just gets us to 165, but you guys are familiar with Code Section 165. Right? For losses, they must be realized, recognized, and allowed. Question 2. Law student spouse completed computer programming school just prior to the student entering law school. Spouse contact, by the way, I'm doing a blank here. I'm not just doing a blank, but I'm assuming for the moment no one is interested on the CPA morning session a week from this Friday. 2 weeks from this Friday. Anyway, if you're interested, see me after class and just, I want to make sure. Anyway. The law student spouse completed computer programming school just prior to the student entering law school. Spouse contacts a talent agent, a talent search firm, to help find a position at a part-time computer program. To help find a position as a part-time computer programmer, as an independent contractor. Consider whether spouse's search fees are deductible in the following circumstances. Okay? The firm is unsuccessful in finding spouse position. Okay? Is that deductible? And let's just make the fee $1,000. Okay? So the spouse completed computer programming school just prior, and now it's going to contract a talent firm to find a position. Is that fee deductible? Angie, Kim, what do you guys say?
I think it's deductible since this is the first time looking.
Think it is, Kim? Agree or disagree?
No, I would say no, cause it looks like she just started, this will be her first time getting a job, so it would be deductible.
Where would you look for authority, or whether, David, your hands up?
The Frankie's?
Well, there's even a better authority. Frank is really not with respect to his job. What was that, Angie?
I would say just a business expense.
But where would you look for an answer? 162 really doesn't help much because it doesn't address this directly. EK, you were going to say?
I think it has to be capitalized.
You think it has to be capitalized, but again, where would you look for the outcome? Your revenue ruling, right? Entitled 75-120 is directly on point, guys. It talks about payment for finding jobs, right? Expenses associated with finding a new job. And that revenue ruling, David, says what? Do you recall?
Rules that fees paid to employment agencies for actual securing our initial employment.
Or deductible or capital?
Sorry.
For initial jobs, what do you have to do?
Deductible.
They are?
That's what it says, yeah. As for me seeking employment, we're deductible, we're 60, yeah.
Yeah, but I think that's if you're, I think you're reading in that context, David. It's
Sorry.
in the context of which you're already in a job and you have an employment agency find you a related job, that's deductible. But to find a new job, generally that's considered like a startup expense, and it has to be capitalized. Okay? And if the firm is successful in finding a spouse job, likewise, has to be capitalized. Okay? So whether or not successful or not, the expense generally has to be capitalized. In question C, same as B, except the firm's fee was contingent upon securing position for a spouse, and the payments will not become due until the spouse has begun working. Deductible or not? Anyone a very close reader? Vikram,
So it's deductible.
what's your authority?
Baseball case, I don't know.
The baseball case, yes, the baseball case. If you look on page 339, the second paragraph that starts now a person. You go down 10 or 12 lines on page 339. The Hunley decision. You see that, Vikram? That's what you're referring to in italics. And here the taxpayer structured that the payment would not be due until he was actually a baseball player. Okay? His coach, who happened to be his father, said, look, I'll train you, but you don't have to pay me until you're actually playing baseball. And the court ruled there that the taxpayer was carrying on the trader business, and in that case, it was held to be deductible. So the taxpayer was able to shoehorn themselves into success by structuring the transaction in a manner where they can meet the requisite under 162 of actually carrying on a trader business at the time the payment was due. Kind of tricky, but it worked. So for your notes, should be deductible. Vikram?
I was just gonna ask, like, what was the answer for B, a question?
Not deductible, capitalized, startup expense. Question C, deductible. What's my authority? The Hunley decision. Frank?
So, you're saying capitalized would be in practical terms, I guess, what does that mean? If I'm, like, that's an individual taxpayer, right? Can they capitalize something like that?
No, as a practical matter, whatever that $1,000 expense is in the year 2018, did they even try to advertise it? It's a miscellaneous itemized deduction, Frank. It's not gonna be deductible, but we have to see as tax professionals whether or not miscellaneous itemized deductions are gone forever or if they're gonna be revisited. So for your notes, I think it's important to say capitalize. Frank's point is to take it one more step, which in the year 2018, if you advertise that expense, and now it's 1/15 of $1,000 would be deductible, right? So it's not big money, but it would be a miscellaneous itemized deduction. But we know under Code Section 67G, those deductions are suspended until the year 2026. So that's a practical matter, even if it were deductible. It's not gonna get, like, question C, you're like, yes, we got a deduction, we got this Hunley decision, right? Theoretically, you qualify. But at the end of the day, it's not gonna end up on your client's tax return, all right? Everyone understand that? You qualify, but then when you take it the last step, not gonna qualify for an actual deduction. Question D, same as A above, A and B above, except that spouse previously worked as a computer programmer in Old Town and seeks a position in New Town where student attends law school. So she's a computer programmer in one town, she's paying a $1,000 fee to remain a computer programmer in New Town. Okay? Would that be deductible? Julia, deductible or not, and Simone, see if you agree. Say good, Julia? Non-deductible. Simone, agree or disagree? Agree? And then, Ning, you get the final word. You say not deductible.
I'm not sure.
Not sure. Elizabeth?
I think it's deductible because he's looking for the same trade of business.
All right. What's your authority?
The Hunley.
No, not Hunley. Say again, Leo, do you know? Rolla?
Revenue ruling.
Yes, the revenue ruling, 75-120. Question E, same as D, except that the firm is successful in finding spouse a position in Newtown as a sales representative. Okay, same as D, except that the firm is successful in finding spouse a new position in Newtown, not as a computer programmer, but as a sales representative. So Nick C, what do you say? And then Nick, other Nick, see if you agree or not. Deductible or not?
I think it's deductible, but I'm not sure if the new job allows the same revenue ruling to apply.
Nick, agree or disagree with Andy? Kind of work.
I agree. Because it's the same, isn't it?
Andy, agree? Deductible? Not sure, Brian?
I think it's non-deductible.
Non-deductible. Why? What's your authority?
The revenue ruling.
Yeah, the revenue ruling says it's not deductible. And if it's a new trade or business, it's like a startup expense. You gotta capitalize it.
So it's the same revenue ruling.
Yeah, 75-120.
Question D was deductible, you said?
Question D, we said was deductible. Question E, we're saying is non-deductible. Okay? Now, if you look, again, what the authors are going to do is untag it to code section 162. So if you want to go back and make sure your book, you have code section 162 in front of you. It says there shall be allowed as a deduction all the ordinary and necessary expenses paid or incurred during the tax year in carrying on any trade or business, including, notice, a reasonable allowance for salaries or other compensation for personal services actually rendered. Everyone see that? Personal services actually rendered. And notice the adjective, reasonable allowance. Now, who cares? Let's start with that. Who cares? In other words, in Exacto Spring, let's bear in mind, if the company makes $10 million, picture if you will, the company makes $10 million, and this guy pays himself $6 million. Right? You got the visual? Company makes 10, he pays himself a salary of 6. Why should the IRS care whether or not this taxpayer pays himself $6 million, $5 million, $2 million, or $9 million? What's the skin in the game, guys? What's the juice?
That's a win.
Okay.
Income is being reduced by the deduction of the full salary.
The,
So it's being
the
less-
corporation is going to have a reduced taxable income, right? As a result of the salary. Everyone agree? And let me give you a statistic that's true in the United States. What percentage of companies pay tax? Now, let me pause for a moment. There's two main kind of companies in the United States. So-called C corporations, beginning in subchapter C of the Internal Revenue Code, code section 301. And what's the other kind of corporation, guys? S corp. Code section 1361. Okay? S corporations are never taxed. C corporations are taxed. Why aren't all corporations therefore S corporations? Because there's many limitations with S corporations. In particular, you can't have more than 100 shareholders, right? So you can't have an S corporation on the NASDAQ or Dow Jones, right? Because would never qualify. Too many shareholders, right? Can't have 1 million people be shareholders. Okay. So S corporations never pay tax. What percentage of C corporations pay tax? Probably about 20%. Now, does that mean 80% of corporations are being derelict in their duties? What does it mean? If I tell you that 80% of C corporations don't pay tax, it means that many are closely held, and towards the end of the year, the people who own the C corporation look in the mirror and they say, gee, company made $4 million this year, pinch themselves on the cheek. I'm going to give myself a bonus of $4 million, and the company goes from $4 million taxable to 0, right? Because code section 162A1, you can get a deduction for salary. Everyone get the visual? So many companies, there's a phraseology out there, comp out, right? They comp out so that the company has no taxable income. It's not illegal, and you as accountants will often tell your clients comp out. Why? What's the downside if they don't comp out? Not they, let's use our pronouns. The corporation pays tax. What's the highest corporate tax rate? 21%. It's not only the highest, it's the only one, right? There's one corporate tax rate. Where's that rate found? What code section? Code section 11. Code section 11. It's a corporate tax rate of 21%. All right? So, corporations will often look to take a lot of compensation income as deductible. Because if they don't, let's look at this company that I alluded to before, where the company earned 10 million, and I told you you took a salary of how much? 6, okay? The IRS can come back and say, you know what? You really only deserve the salary of $1 million. The other $5 million is not deductible. And what we're gonna do is, so the company, just use my simplified back pattern here. Before, the company got a deduction of 6, and there's only tax paid on 4. The IRS comes back and says, no, only $1 million is deductible. Companies should pay tax on $9 million. And this delta between the two of $5 million, what is that going to be called? What does the IRS call that? In other words, the taxpayer truly did get $6 million, right? And the IRS is saying $1 million is salary. What's the other $5 million?
Is that a dividend?
Yeah, constructed dividend, right? Dividends are not deductible, okay? Dividend payments are not deductible. And why are these cases not that often brought these days? Why? Because if that's true, the taxpayer, how is this $6 million taxed? The $6 million is taxed as ordinary income. Everyone agree? Payment for salary. If the IRS is successful, be careful what you wish for the IRS, because if the agency is successful, then the taxpayer would have a $1 million of ordinary income, and what about the $5 million? How is that treated? It's treated as a qualified dividend, which is taxable at capital gains rate. So the IRS could get a larger corporate income tax as a result of this recharacterization, but the taxpayer, on the $6 million the taxpayer receives in hand, may ultimately pay a smaller overall tax onus. Why? Because now it's $5 million of qualified dividends and $1 million of salary. So all I'm pointing out is in the year 2018, the IRS has less incentive to pursue these cases. Did I lose people on that? Vikram?
So you're saying that the taxpayer will only pay a lower tax, you said?
Overall, the taxpayer, and let's be careful, the individual taxpayer, not the corporate taxpayer. The corporate taxpayer will pay a much higher tax. The individual taxpayer, though, stands to pay a much lower tax burden. Okay? We have 2 taxpayers here.
Corporate taxpayer.
Okay? All right, so that's a little background. Why, at least historically, the IRS brought these cases. The IRS historically brought these cases because to the extent the IRS could say, gee, the salary you list is excessive, they could make the corporate tax rate go very high, that the corporate tax burden increase significantly. Okay? That was, the IRS had an incentive. Disallow the salary deduction, because to the extent it disallowed the salary deduction, that could cause, the disallowed salary deduction could cause the corporate taxpayer to pay a much larger tax bonus. All right, Exacto spring. We'll see how this plays out in a moment. Volunteers, anyone look at this case? Not a hard case to read. Anyone read this case and say, gee, you couldn't wait to talk about it? Don't all raise your hand at once. Kim,
I read it.
you read it? You want to tell us about it? What happens here?
It was basically what you
Just say it
talked
loudly,
about. It
so-
was basically what you just talked about in terms of was the salary paid to Heights, which is the co-founder of Exacto, was his salary excessive?
Well, the issue for sure was this reasonable salary, right? That's the issue. And the taxpayer deducted 1.3 million and 1 million in salary, and the IRS comes back and says, no, 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 it should be a much lower number, okay? And what does the tax court do? Given that there's such a discrepancy between what the taxpayer says and what the IRS says, they split it, right? It's like Solomon, right? You split the baby in half. So essentially, the taxpayer says one number, the IRS says another, and the court just splits the difference between the two. And once word gets out, what do you think that incentivizes taxpayers and the IRS to do? Take extreme positions, right? Because the more you deduct, the better the leverage you have, right? With the negotiation, if you know the arbitrator is just going to split the difference. And that's why a lot of baseball use first offer, what is it called? First offer arbitration, or what's the phraseology where an arbitrator can only use has to choose one or the other number, and this way it forces people to be reasonable, because the more of an outlier you create, the less likely your number is to be chosen. But the way the justice, that's not how it works in tax court decisions, apparently. The tax court considers these numbers and, well, let's put it this way, often splits the numbers. Now, Judge Posner, you may or may not know this, he's from the Chicago School, taught many, many years at University of Chicago. He's a judge. He just recently retired. He also is one of the most prolific people I've ever seen walk this planet. Like every time I look at the New York Times book review, the guy has a new book. So I don't know how the guy breathes, but very, very prolific author. Was, during the time of Ronald Reagan, seriously considered for the U.S. Supreme Court case, but ultimately the social conservatives did not want him because he was considered too much of a wild card, because he's a true economist, and people thought, particularly with the hot-butted issue of abortion, that he would weigh things from an economic perspective, and he wasn't thought about as being a guaranteed vote. So he was considered but never nominated. But still, a very, very deep thinker. And I think you could get that in this opinion, deep thinker. Because, Kim, what was the test that the tax court applied?
The 7-factor.
Okay, so the tax court applies the 7-factor test to determine whether or not the salary is reasonable. Is that a black and white, crisp test?
No, from the reading of it, it seems like it's.
No, it's the antithesis of black and white, right? It is not black and white at all. It's a hard test to apply. Okay, is that a fair statement, Kim?
Yes.
Very hard test to apply in practice. So, Judge Posner, if you couldn't tell, is no big fan. In fact, when he applies the test, the conclusion he draws is the taxpayer should resoundingly win, right?
Yeah.
But he wants to create a new test, right?
Yes, he did, the independent investor test.
Right. Judge Posner wants to create something known as the independent investor test, okay? Where he says, gee, I don't like this multi-factor test. We should just look, what would an independent investor say in this context? Would an independent investor, given the profitability of this company, permit this salary, okay? What would an independent investor say in this context? That is the test he's going to gravitate towards. And Kim, what does Judge Posner say?
Regarding the independent investor tax?
Yes, in terms of applying it here, who prevails?
The Exacto prevails in this case.
Right, the taxpayer prevails, right? Applying the independent investor test, the taxpayer here was very successful in making the company more profitable, and as a result, truly was worth the salary that was being paid. So the takeaway is that this was a reasonable fee, reasonable. Okay? So given the brilliance, I'll say, of Judge Posner, does that mean game over, that this is the test, Kim, that the courts now universally use?
No.
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 And the note that follows, this is still an outlier, guys. Still an outlier. Judge Posner has not stemmed the tide, as they say. So Judge Posner has not been successful in making this the go-to test. Right, so we still have the 7-factor test, we still have Exacto. This is still not an issue that has gone away, but it's not, like I said, the IRS does not litigate this case as often as it used to because, again, if it wins, it loses, potentially. It wins with one taxpayer and with the corporate taxpayer, and it loses with the individual taxpayer. So the IRS has to think twice whether or not it makes sense. Harold's Club. Another case, not a hard case to read. What is the takeaway? What are some of the salient background facts in Harold's Club? Any volunteers? Jacqueline, you seem like you're up on this. You have to be careful when I say that.
Yeah.
Did you have a chance to read it?
Well, I used to part.
They get that, we're not that ambitious. Angie? Out there, Brian?
Taxpayer owns an illegal gaming establishment, and then the taxpayer entered into a fixed percentage arrangement with the casino, I guess you call it.
So he's gonna get salary plus a bonus, right?
Right.
That's on revenues generated. I think it's 20%, right?
Yeah, that's what I thought.
Okay, keep going.
So the club or the casino deducted that amount.
So taxpayer gets paid big bucks in large part because of this kind of contingent payment arrangement, right?
Yep.
And the question is whether or not these payments are deductible, right? And what does this hinge on?
Whether it's reasonable.
Is it? We know it's not reasonable, but is there a plan B that the taxpayer can rely on? Any plan B here?
The casino is doing really well, so the taxpayer.
Let me just ask you a question, Brian. Could you imagine that you work for an accounting firm, and to lure you to the accounting firm, they say to Brian, look, and let's just say, this is me speaking, Brian's worth $200,000 a year, but the firm says, look, Brian, we're gonna pay you $200,000 base, because that's the going rate for someone with your experience. But if the revenues of the firm increase over the course of the year, and it reaches a $5 million floor or ceiling, depending on how you want to do it. For every $1 million that it's beyond $10 million, because of you being here and whatever work you generate, we're gonna pay you 20% on any amount of gross revenue above 10 million. And you work your backside off. And all of a sudden, the firm's gross revenue skyrockets to $13 million. And they pay you an additional $600,000. Everyone have the visual? Base salary of $200,000. And now, with Brian's good negotiator, he's got a 20% contingent payment, right? And he really worked hard and got some really great clients. And the firm's gross revenue shot upwards. Is that salary reasonable or unreasonable? And normally, don't take offense to this, Brian would normally only get $200,000, now he's gonna clear $800,000. Is that $800,000 deductible, and if so, what's your authority? Everyone have that visual in front of them, right? And if you turn to regulation 162-7B, let's take a look at it together. Compensation for personal services, everyone have it? And if you have 7B2, the second half of regulation 162-7B2. Generally speaking, if contingent compensation is paid pursuant to a free bargain, circle the word free bargain. Everyone see free bargain? Between the employer and the individual made before the services are rendered, and this was before the services are rendered, not influenced by any consideration on the part of the employer other than that of securing on fair and advantageous terms the services of the individual, it should be allowed as a deduction even though in the actual working out of the contract it may prove to be greater than the amount that would ordinarily be paid. Everyone see that as long as it's freely bargained for, we're going to give some leeway here, right? And the $800,000 to Brian, kudos to him. He's going to get paid that, and it should be deductible, right, Brian? Now, was it in Harold's Club? Was it deductible? Do you recall, Brian?
I don't think the whole thing was.
It was not. And why was it not? Do you recall? And it wasn't just because it wasn't reasonable. Anyone have? Go ahead, Elizabeth. What a weekend you had.
Wonderful.
My kind of weekend.
Well, the commissioner claimed that the father was the one who imposed the salary in that arrangement, and it wasn't really a free bargain.
All right,
More
picture
than
if you
a
will.
position of the dad on the son to be able to deduct as much taxes as
Hey,
possible.
how many sons or children do you know who can sit across from the table, arm's length from dad, and say, Dad, you know what? We're not going to pay you as much as you want, right? In other words, what's the free bargain means that it's at arm's length. But if dad controls the sons, which apparently, right, Elizabeth, he did,
At least that's what the commissioner said.
there's no free bargain, right? In other words, there's not freely, like when Brian negotiates with a Big Four accounting firm for his salary, that's a tough negotiation, right? But if Brian was negotiating with his father, you know, it's gonna be a whole different air, right? And if it's not freely bargained for, doesn't meet the test, and therefore not gonna be deductible. All right? And the opinion, right? Right? It elaborates about dominion and control of dad over the sons, right? This is spelled out. So therefore, taxpayer loses. Taxpayer loses. Page 355. the authors introduce us to two different code sections that have some relevance, that Congress, to stop excessive salary payments, limits deductions to essentially $1 million in the case of publicly traded companies. There are some gaping loopholes in this, but under Code Section 162M, there's supposed to be a limitation. Again, capping the salary deduction to $1 million. In the case of golden parachutes, those are large payments that are made if there is a change of ownership.
I have a quick question about the 1 million. Is that 1 million totality, or is it?
1 million per employee. Golden parachutes, there's a code section 280G that if there is a change of ownership, if the payment exceeds 3 times the person's base salary, that there's an excise tax that applies. It's spelled out again. You gotta be careful. There's a lot of code sections that don't come up with frequency that can be traps for the unwary. Code section 280, capital letter G. The authors, just again, why are the authors calling this your attention? Because Code Section 162A1 has this pretty general amorphous test of reasonable salary. But here you see 162M and Code Section 280G, there's no amorphous standard. One is a strict $1 million cap. The second is 3 times prior base. And you can get caught up in either code section. Let's look at the problem on page 356. Employee is a major shareholder, 248 shares, and is president of the corporation. Shortly after the corporation was incorporated, its directors adopted a resolution establishing a contingent compensation contract for employee. The plan provided for corporations to pay employee a nominal salary plus an annual bonus based on a percentage of the corporation's net income. In the early years of the plan, payments to employee averaged $50,000 annually. In recent years, corporations' profits have increased substantially. As a consequence, employees have received these robust payments averaging more than $200,000 per year. All right, so picture $50,000 for 5 years, and then all of a sudden it jumps to $200,000 because of the contingent payment arrangement. What are the corporation's possible alternative tax treatments for the payments? And this dovetails with the discussion I was raising before. The corporation generally can treat it as a deductible salary or a non-deductible dividend payment. Everyone agree? Generally, that's really the two major choices. Deductible salary, non-deductible dividend payment. It says in question B, what factors should be considered? And like Kim was saying, referencing the Exacto spring case, right, Kim? Mm-hmm. You could, or the tax court would, possibly rely on the 7-factor test, right?
Yeah,
I'm sorry?
the independent.
Or in independent spring, Judge Posner would say, no, not the 7-factor test, but the independent investor test, okay? So it will depend on what court you bring your case before. There's different tests that may apply. Now, that's one facet. And the second facet, as Brian might allude to, based on Harold's Club, even if it's not reasonable, if the contingent payment is based on a free bargain, right? Like, don't take offense to this, Brian. When Brian gets paid $800,000 in my example, we know Brian's only worth $200,000. But is the $800,000 deemed reasonable? Yes, because under 162-7B, B2, it's deemed reasonable because it's freely bargained for. So if you fail at the reasonable test, maybe you're gonna be successful under this Plan B test that is the contingent payment arrangement. In question C, it says the problem assumes employees always own 248 out of the 250 shares. Might it be important to learn the compensation contract was made at a time when the employee held only 10 out of the 250 shares? So Brian, what the heck, I'll put you on the spot. Would that change your answer?
No.
It wouldn't. And Nick, would that change your answer? Anyone change it, or everyone's gonna keep their cards the same? Mike?
You would be able to argue that it was a free bargain because if they always own 248 out of 250, it would be obviously controlled by the taxpayer. But if they only own 10 out of 250 in the beginning, they weren't a controlling.
Yeah, it makes a stronger argument, right, that at the time it was entered into the contract, that it was freely bargained for. Because if you're a minority shareholder, like Brian initially at the accounting firm, maybe he was a partner, but he only had 10%. Okay, and it was truly hardcore negotiation, the contractual arrangement. So I'm not saying it's a definitive winner, but it would color the outcome here. So the answer could, taxpayer has a much better chance of prevailing if at the time the contract entered into, it was freely bargained for. Let's talk about travel away from home. Now keep in mind, take a look at code section 162A2. 162A2. It says that travel expenses, including amounts expended for meals and lodging, other than amounts which are lavish or extravagant under the circumstances, while away from home in the pursuit of a trade or business. So here's some key terms. You gotta be away from home in pursuit of a trade or business. Now I know this sounds like a silly question, but what does the word home mean? What does the word home mean? Say again? Personal residence might be a reasonable answer, right? Simone, that IRS uses the word home. How do you think the IRS has interpreted this? The word home. Say again?
Home city.
Say again?
Home city, like the actual city.
Not home city, they've interpreted it to mean your business headquarters. That you can only deduct travel expenses where you're away from home, meaning where your principal place of business is. So, using Brian again, if he lives, say, in Summit, New Jersey, but if he works in New York City, okay, at KPMG, New York City, he's only away from home if he has to travel away from his New York office, right? Now,
If you have a home office, it's all the same.
well, no, he lives in Summit, but his business office is New York. But let me just draw, and then we'll talk more. Travel away from home is a tough issue, but let's get one point clear. You know, this chapter starts off with the cliche, it takes money to make money. Everyone agree that when you spend money to make more money, generally, that's an aroma of being deductible, okay? Everyone got that? You spend money to make money, it should be theoretically deductible. Right, but using my fact pattern, suppose Brian lives in Summit, New Jersey, commutes to New York City at KPMG where he gets a salary of 800,000 using my numbers before, okay? And every month he incurs $1,000 worth of travel expense, right? And he's only spending that $1,000 to make the 800,000 or $12,000 a year, right? $1,000 a month. He gets train tickets from Summit Express. Why shouldn't that $12,000 be deductible, right? Because he's deducting, or excuse me, he's incurring $12,000 worth of expenditures to make that $800,000. Everyone agree? So why not, Amanda, make that deductible?
Because it's so small in comparison.
Never stopped anyone? I'll make it more expensive. He takes his Maserati that instead of being $1,000 train ticket, let's make it $3,000 a month or $36,000 a year. Francis, does that change your outcome? And then Mike will tell you. You say deductible or not deductible? Not deductible. Why? Mike?
It's because when you're choosing out employment, the IRS is assuming that you're factoring in what your travel expenses are to your main place of employment.
Well, think about it. Brian decided to live in Summit, New Jersey. He works, on the west side on 43rd Street. He could have lived on 44th Street and walked to the office, right? Or maybe even lived in the same building as the office and just took an elevator to a different floor and voila, the door's open, he's at his job. So his choice of living in the Summit is a personal choice. So what are commuting expenses? Personal, 262 expenses, right? So bear that in mind, guys, as you're reading through the material for next week, that many times the question is it deductible under 162 or is it a personal expense under 262? Now, in terms of where we're going to be, guys, one other thing, can you just read, we're going to go another 40 pages under business deductions, and then just read the first 3 or 4 pages in chapter 17. Okay, chapter 17 is on page 501. Just read up to page 509 in chapter 17, 501 to 509. But also in chapter 14, please read another 40 pages or so. All right, so be ambitious, guys. Lots of reading for next class. Happy Halloween to everyone. You can dress up as a tax professional. All right. I'll see everyone next week.